Hello, how's it going today? I'm doing pretty good, thanks. Going to talk about one of my favorite topics today again, and there's more to negotiate in the sale of real estate other than the purchase price. And we're going to go over some key components of this and performance indicators that, will set from a seller's point of view, will help you, if you're a seller, will help you negotiate with the buyer better. And if you're a buyer, we're going to give you the same points of views and help you kind of construct your offer a little better and understand what goes into that. So obviously, as we go through this, some of this is going to depend on whether it's a buyer's market or a seller's market or neutral. All of that kind of plays an effect. The speed of the market kind of plays an effect on all this. But anyway, performance indicators as we roll through them. Purchase price is purchase price. Like highest offer doesn't always mean the best. And sellers, you need to remember that because there's other terms in the contract or an offer that can affect performance from a buyer, and if they're going to buy you out eventually, right? And buyers, you need to remember that. Like, be thoughtful. It's one like you have to be within reason. Like you have to get the seller's attention with your offering price, but you also have to be mindful of what that means to you in the long term because now you're cashing out the seller and you're turning this into an investment for you. So, what's the short term play? What's the long term play? What's your goals and objectives? Um, Closing costs and prepaid expenses. Um, Buyers can ask sellers to pay for their closing costs and prepaid expenses. Not always advisable, depending on what type of market you're in. Buyer's market, you can get away with that more often. Seller's market, sellers are going to go, wait a second, I don't always want to do that and keep losing equity or, give away part of my equity here just so you buy my place. So in a seller's market, you may get a little bit of pushback. In a buyer's market, you may see sellers offer it as an incentive like, hey, we know it's a buyer's market. And oh, by the way, here's an incentive to buy my property. But you're not going to see those incentives so much in a seller's market. Uh, Financing concessions. This could be any realm of things. A seller, say it's a buyer's market, for example. A seller could offer to pay for some finance concessions for the buyer, and that would include even doing buying down the interest rate for the buyer, paying for an appraisal, uh, loan origination fees. You can kind of look at all that and see what it means to you globally for a seller and a buyer's market. In a seller's market, you're not going to see so much financing concessions. Buyers have to, in a seller's market, really kind of suck it up or, have some money saved up or get a gift from family or friends or, sell some assets, some other assets to get bought into some real estate. It just kind of depends on the movement and the speed of the market and kind of what's all going on at that given point in time. A home warranty. So if you're buying a home and you have some concerns, over the hot water heater, the age of the furnace, condition of the air conditioner, condition of the stove, refrigerator, any sort of appliance that's kind of a machine in your house working. These things, they work every day for you, right? It's like an engine in your car. Every day that they get used or every cycle that they get used, it's just uh, one more time they're getting closer to a point where they're going to need repair and or replaced. So a home warranty, and I think of it like this. Um, there are two types of people in the world. One, they're overinsured on everything. They want an insurance policy for everything. They want to know that they got some coverages no matter what happens in life, no matter what life throws them. They've got a policy for that, and they're willing to pay a monthly stipend for that, and that's okay. And then there's other people on the other side of the aisle. They dislike insurance. They won't carry insurance unless it's mandated by you know local, state, or federal government. Um, And a home warranty is one of those. That's not mandated so much by anybody. So that's kind of optional, right? But the other thing, you know, in any market, I'm going to say this for any market, seller market or buyer market, the age of your appliances and the condition can play a role no matter what. So, from a buyer's point of view, this could be a tool that could make or break a deal. Do you need to step into this? Because when I buy a property, I'm going to live in it differently than you've been living in it, right? And so the working components of these appliances kind of changes a little bit, and that sometimes could be enough to, you know, it doesn't want to work no more. I've seen it. I laugh at it. I've seen it. It's not fun. You know, you're living there that first week or two, and pretty soon the furnace is gone. You know, well, it's because different heat. What I set the temperature at for heat is going to be different than you, or whatever's going on. Number of times you get in the refrigerator, number of times that thing cycles on and off. So anyway, a home warranty company can kind of step in and mitigate some of that. Again, it's a tool, and it doesn't matter what kind of selling market we're in. It is a tool that we have access to that can make or break a deal. And so buyers and sellers both kind of need to be thinking about that and what it means to you. Possession. Most of the time, it's assumed that buyers want possession at closing. That's kind of the soft assumption. But in a seller's market, especially right now, today, we're in a time period where there's limited inventory. Okay. So I've seen deals where the seller specifically says, hey, I'll sell you my house or I'll sell you my real estate, but I get 90 days to find a replacement after we close, meaning I want you to buy me out. I need your cash. And then I'm going to go buy my next real estate. And oh, by the way, I'm going to sit here and I'll, a good lot of times the seller is usually kind of cognitive of the situation. They'll pay back rent to the buyer, right? Or there's some sort of compensation, but not always. Sometimes it's just negotiated as part of the deal. Hey, Mr. and Mrs. Buyer, you wanted a deal on the price, so I'm going to rent it back for free for up to 3 months or whatever. And there's mortgages out there in the world that will allow buyers to do this. You need to talk to your mortgage agent about that and see what those mortgage types are and what the terms are, because you don't want to be caught in a rat hole of, hey, I'm buying this for my primary residence, and then I turn around and rent it out and I look like an investor, and you don't want that mortgage to get called due. So we got to be mindful of those things as we enter into those transactions. But the other thing too, like sometimes there's properties that are vacant prior, as we look at them, or we know that the seller's moving out here within a couple of weeks or whatever the circumstances are, now we can sit and talk about early possession. And we see this in all market types, sellers markets, buyers markets, neutral markets. Sometimes the seller's just got the wherewithal to move on, get the place empty. It shows motivation, number one. Number two, you're not under such a time crunch. And, that early possession can really help a buyer. And that, too, that could mean something price wise. What it means to me could mean something different to you. And there's a value that you can assess to that, especially with the speed and timing and da. So, obviously we got to check with insurance companies to make sure the seller can do that. And, if there's any ramifications there, get some additional riders kind of set up for both the buyer and the seller as a tenant and a landlord. So anyway, those are all things that we can look at moving into different types of sales. The closing date, maybe let's go back to possession. Maybe the seller is willing to grant early occupancy to the buyer, and we're going to push that closing date out 3 or 6 months. I just heard this here recently last week. The buyer, told the seller up front, hey, I need 3 months to get my finances squared away. I need my taxes done. I got to get A, B, C done before I can buy you out. And here's why. And they sat down with the seller and got to know each other a little bit, and by golly, they got that deal pulled off. And so the closing date become a negotiable term. So, the seller obviously was like, well, if I'm going to do that for you, I'm going to be a little stiffer on, negotiating that purchase price. And the seller was like, hey, I don't care. Like, I just need some time. Right. So, and the flip flop, possibly there's sellers that are under distress. We see this all the time with foreclosures, short sales. Um, maybe there's a tax lien or an IRS lien, something that's causing the seller to sell more quickly. Divorces, right? We see that with divorces. There's a trigger that's caused the seller to be in distress, speed up the time of the sale. So we may see, the seller say, hey, I will sell it to you, but I need bought out in 2 weeks. Or we see the buyer say, hey, I'm an investor, I got cash. I can close you in 10 days. I can close you in 30 days. Now, this is all about perception a little bit too. I ran into a deal here recently where some folks were coming out of California, and to be speedy there, they were telling me, you could put a 30-day close and the seller would recognize that was moving right along. And here they were telling us to do a 30-day close and let the seller know and blah, blah, blah. And finally I had to stop, I had to just stop the whole conversation, try to understand what the buyer was talking about. And they're like, we got cash, we can move quick. And the seller needs to know that. And, if time is of the essence, they need to know that. And I was like, well, here we can pull that off, 5 days, 10 days, 15, whatever. So some of that comes down to perception. Some of that comes down to past experiences. We're going to be dealing with buyers and sellers that have different experiences from the past or no experiences, like, first time home buyer, first time seller. Could be zero experiences. We got to weigh in and learn these things as we move through the motions, and really dial in on what's important. And, again, possession would tie back into that conversation, a closing date. If we close early, we got a seller under distress. They're wanting to close early. They need to cash out. They need to get out from under whatever burden is causing them harm. But then, the seller needs we close it in 10 days, but they need 30 days to move because they got a lot of stuff. We've seen that. Or we do a partial possession where, we give up, the garage and not the house, or vice versa, or the livestock stay behind on the property, but everything else goes. Like, anything you can imagine kind of gets tossed in these two brackets of possession and closing. And it means something different for everybody. It really does. So just kind of be mindful of that when you're sellers, when you're looking at offers, buyers, when you're composing offers. Other contingencies. Simply put, sellers don't like contingencies. Buyers want some coverages. So you got to kind of do the dance, do the two-step, and learn. Buyer's going to offer you up front, and you're going to learn what their concerns are, kind of what, and some risk management. Some buyers come to the table with different risk management thought processes. But you got to, you can't be overburdened. Like, you don't want to be overloaded on financing and inspections and unrealistic things too for the, if it's a buyer's market or seller's market or whatever. Appraisal contingencies loaded on, hey, I got to sell my car in order to enable to buy your house or buy your real estate, or I'm 2 months away from having this foreclosure off my record. I've been sitting there for 2 years. I had this foreclosure, and now I'm 2 months away. I just want this is my dream house. We hear this all the time from people who have gone through foreclosure. They're tired of renting, and they just want to secure a new roof over their head. So they got these contingencies built in, like, hey, we know this is going on. This is why. Here's our contingency. And oh, by the way, if you don't fulfill, I want my earnest money back. And if you're the seller, if the buyer doesn't fulfill, oh, by the way, I want your earnest money for damages for holding my property under contract. So anyway, that gets to be kind of an interesting conversation as buyers and sellers bring unique contingencies to the table. And to be fair, realtors are not lawyers. Okay. If you got something unique and something legitimate, we're going to need advice from your attorney before we go to putting these offers together and putting these contracts together. It is not fair to rely on us to come up to dream up some verbiage that'll cover your contingency. Um, we got lawyers that give us verbiage. They don't give it to us; we pay for it, right? But um, we've gotten some of that through the years. But in all fairness, don't expect us to act like lawyers because we're not. And if we just put everything on pause and we say that, be respectful. Just know that the real estate's likely going to be for sale tomorrow, just like it was today. And if not, as a buyer, you're too late to the game. As a seller, you should have been prepared prior to entering the market. So just be mindful of that. Earnest money itself. Let's talk about that for a second. So buyers, from a buyer's point of view, you want to offer nothing or the lowest amount possible that will harm your pocketbook, right? Now, from a seller's point of view, you want the most amount of money to make sure that buyer is going to perform on the contract once we go under contract and make it to the finish line and not quit on the 11th hour. So this, you get to kind of do the two-step. In Wyoming, we can make earnest money non-refundable. The state contracts don't always offer that, but it's a tool and a lever that we can pull. And the smartest way to do that is, this is just my opinion. Okay. Now I've seen this take all sorts of, kind of directions and different ways, and it means something different to everybody, but let the buyer get through the, at least title contingency and inspections. Financing is going to run right up to the end, especially if appraisers are, 2 or 3 weeks behind. That's kind of going to run right up to the end, but we can get a lot of these major contingencies knocked out. And if we do, and we're successful and the buyer is satisfied at that point, then make the earnest money non-refundable. Or if you're a super aggressive buyer, be like, hey, here's a large sum of earnest money. I'm not walking away from this deal unless I die. So, by the way, here's X amount of dollars, non-refundable from the get-go. Buyers can do that. I've seen it. That is a lever they can pull in the original offer to get the seller's attention. But if you guys kind of want to have 1 foot in, 1 foot out, you're going to offer, from a buyer's point of view, you're going to offer the least amount of money and have all the contingencies built in. And oh, by the way, if something isn't satisfied by the seller, I'm out. I'm going to walk away from the deal and get my earnest money back, because most of these state offers are, they're spelled out good enough that buyers have those opportunities. Sellers need to be respectful of that, and you need to let the buyers kind of walk through some of their contingencies, do their due diligence, give them some time. And good listing agents kind of have a lot of this knocked out in before we enter the market anyway. Other listing agents don't. I'll just leave that alone. But earnest money can be a big deal. I've done deals that had 0 earnest money, and I've done deals that's had near 6 figures. It just depends on everybody's comfort level, the type of real estate, the level of money that's at stake. Are we uprooting a business or not? So many factors go into just that conversation. It's crazy. One of which, working for buyers, we have these conversations kind of leading into looking at properties and looking at real estate. And if I'm doing a good job, I should have you educated about that before it's offer time. Sellers, we're talking about that from the word go. And we're coaching you on that from the word go. Good listing agents do that from the word go. I got this stuff hanging on my wall. Those of you that's been in my office, these things hang on my wall. I preach it. I walk it every day. Buyers, same way. If you've been in my office, you see these things. I've prepped you. It's in your file. Sellers, they're in your sellers' files. we're going to continually talk about these things because sometimes a deal surfaces that you just never knew was possible until somebody presented it. Um, Mortgage buy downs, that can be negotiated. We see this a lot, especially with new home construction, doing a 3-2-1 buy down or 2-1 buy down, or even an interest rate buy down of some kind. New home construction is really good at this, but Kenny and we've been super good at this. At least my whole selling career. She taught me from the beginning. This is a tool, and one of the best things I ever learned from her. And even when real estate or when interest rates were down around 3-4%, we were using it from time to time because it was the difference from somebody buying that property or not. It can literally, if it can make any difference in that monthly payment, it can take somebody from being qualified to buy that property to not. I did it on a refinance. I share this story all the time. Interest rates got down to 2.5%. I figured it was time to pull the trigger and refinance my personal home. And I walked in talking to my lender, and jokingly at the time, right? Like I was just like, "Hey, what are discount points worth these days?" And she looked at me kind of funny, and, "You're serious, right?" Well, being snarky, I was like, "Well, yeah, now I am real curious." Lo and behold, nobody was paying attention. Investors weren't paying attention, and of course, discount points they change daily, just like interest rates do, and the cost of getting those points. And she quoted them out to me, and like my recoup time on that was less than 4 months at the time, so I had to pay like $2,000 or $3,000. I got an even lower rate, and it didn't affect my payment. I could afford the 2.5. I could afford my payment at 2.5. I could afford my payment where I was at before the 2.5. But because I asked the question, and then I took her serious, and then I seen the numbers, and we got calculators to show you all this, right? Like, if a lender quotes you what a buy down is, especially your discount points, we can calculate what the return on investment is going to be and how long it's going to take you to get there if you just make the bare minimum payment every month. And by golly, that was such a fun deal. She was a little bit frustrated with me, and she's a sweetheart. Don't get me wrong. She really is a sweetheart, but it's kind of a fun story because, interest rates were 2.5%. Nobody was talking about it. And in the grand scheme of things, this thing is saving me thousands and thousands of dollars still, on top of being less than 2.5% interest on my mortgage. So anyway, and buy downs, again, back like the financing concessions can be negotiated back and forth. Like a seller can offer to do the mortgage buy down for you. The buyer can include it in their offer to the seller. It can go several different directions here, all of which, if it's the deal breaker conversation, we need to air it out and get it on the table, get it in writing, and see if we can bring this full thing together. Sometimes it depends on the price. Like maybe the buyer's willing to pay a price that the seller thinks is too good to be real. We know that it's going to appraise, and we can include that in. It's a win-win for everybody, and it's a grand party after closing. Improvements. Let's talk about that box for a second. Some people live in their properties harder than others. Sometimes there's been accidents that happen. Any number of things can alter a property. Maybe it's just aged. It's, some of the improvements haven't been done for 30 years. A buyer can incorporate that into their offer. We can look at construction loans, 203Ks, escrows. Like maybe it's not something so major that we can't ask the seller, if we pay X price and we know we want, whatever it is, $5,000-$10,000 worth of repairs, and the mortgage lender says, yes, that fits the box for the mortgage, maybe the seller is willing to pay for that. and on commercial stuff for farm and ranch, maybe some of those improvements are a tax write-off. So, now we got to include your tax advisor and get some consultation there, because I've seen a lot of times where the improvements were super important to the buyer, and then the seller has kind of go, they get cold for a second. And then we talk about, hey, maybe you're not really going to lose money here because you own the property. And if we incorporate this into this deal, you can use this on the backside and leverage it on your income taxes. So, and a good lot of that's changed since the Trump administration, and the I forget what that's called here for a second, but we all get like $25,000 limits or whatever before our write-offs start kicking in. Sorry, I wasn't prepared to say that today, but so anyway, some of that's kind of changed, and it's going to change on the real estate type too. So what it means in residential is something different than on commercial, industrial, and everything else. So income producing. So that that is one key where we're not going to need your lawyer so much, but we're going to need your tax advisor, and it could be, some of it could depend on some write-offs you've taken in the past as a seller. And two, as a buyer, maybe you include it in on the deal, and you get to incorporate it in on your income taxes coming up, because that could be an expenditure on your side of the settlement statement. And so again, that's a negotiable tool in the toolbox, all of which can be explored from time to time and mean something different to each and every transaction. And so I kind of tackled repairs and improvements there all in the same conversation, but repairs would go the same way, especially if something showed up after, if a buyer kind of seen your property and then something broke down in between the time of going under contract and closing, all of a sudden we're looking at repairs, or a windstorm or a hailstorm or something like that caused damage to a structure. We got to go back and figure out what that means to the buyer and seller, number one, and number two, if we're going to be able to fix that and still bring it together, or if the parties are just going to walk out on the transaction. So next on the list would be personal property. Buyers can ask for about anything to be included in the sale price. A good lot of that stuff we got to put on a bill of sale, but it's in there to be included in the purchase price. Most generally, people think about appliances, right? Like dishwasher, refrigerator, a range oven, maybe a deep freeze, or possibly even a safe. Like some people get these 1,000-pound safes down in the basement, and then all of a sudden going down is a heck of a lot easier than going up. So pool tables, we see that, or gaming centers. I've done horses, I've done equipment, I've done implements, vehicles, four-wheelers, boats. Kind of one of the early in my career, one of the most unique ones still to date is I sold a lakefront property, and it had a boat dock permit that come along with it. And something you don't, at least in our area, we don't see a ton of, but that property had a boat dock permit, and by golly, that was a big deal for that property. And the people that bought that place knew it, and the seller that had that place knew it. So that was a unique situation where buyer and seller were unique in the fashion that they had a passion for the lake life, fishing, boating, ice fishing, whatever their hobbies were at the lake, or wants and needs. Both of those parties shared similar interests. And that boat dock permit, that was a deal. Like, on ranch land, you see like BLM or state ground leases or Forest Service leases. All these things can be incorporated in. So yeah, don't just think it's always about the real estate. Kind of be thinking outside the box, and sometimes there's personal property there that would be unique to staying with the property. Sometimes it's not. But anyway, we can incorporate that in, and we can say that's included in the purchase price. Or hey, give me a better deal on the purchase price and I'll pay you outside of closing for this personal property. So essentially we got the real estate. So anyway, those conversations take a lot of different rabbit holes, and one of which needs to be taken seriously from one transaction to the next and one buyer seller agreement or offer to the next. And again, what's important to me could be not important to you or vice versa. And it all means something different to everybody. That's what makes real estate unique. Um, Next one, title companies. Typically, my experience is the sellers, if the good listing agents give their sellers options on title insurance companies, who do they want to use? Because they're the sellers purchasing the title insurance to pass on to the buyer, ensuring that there's nothing from the past that's going to hinder title of that real estate. Um, Now, the technical answer is, and I've seen this, a seller could pick title company A, and the buyer doesn't want to use title company A. And I've seen it for any number of reasons. Buyers bring up past experiences. Sometimes there's family that works at title company A and they don't want their family knowing their business. Family and or friends, we'll group them together. Family and or friends that work at title company A. Or it could simply be about coverages. Maybe one, because not all title companies are created equal. Sometimes title company B is going to provide better coverages based on what the buyer is looking for. And again, that this is usually a pretty sophisticated buyer that's coming to the table that has gone around the block a time or two, versus you know a first time or a second time buyer. These are past experiences coming up, and there's trust there. Maybe the buyer has a certain level of trust with a certain title agent or a certain title agency. I've seen that sometimes it's about the people providing the insurance agent themselves. There's a certain level of trust there. So uh, again, my experience is typically the sellers pick up front, and then the buyers usually go along with that, but not always. And then I've seen too where the buyer says, "Hey, I'm not buying this piece of real estate whatsoever unless you use title company B," which kind of gets to be an interesting conversation. But I've seen it happen. I've done it. I've brought that awareness to the table, and you know, uh, we got them solved. Let's just say that we got those concerns solved. We went through some mediation and some brainstorming, and we got those jobs done. So um, lastly, I'm just gonna bring up insurance a little bit. Insurance is getting more and more expensive. It's causing some heartbreak among homeowners and even some heartache with buying real estate because uh, some past underlying issues that kind of remain in the background with these properties because claims kind of, I think the number is a claim can sit with the property for like 10 years or something like that, and it'll sit with the person that filed it too, that filed the claim. So there's actually two different claims that happen in one with these insurance companies, and the comprehensive and loss underwriting exchange records all this. uh, so anyway, sometimes now we're seeing buyers bring these issues to the table and be like, "Hey, something here needs fixed, or we can't buy or won't buy or whatever." And it is what it is. Like we got to negotiate those deals. We got to mediate. We got to mitigate whatever it takes. And sometimes we just got to know when to walk away as a seller or buyer or both, right? And that doesn't apply to seller's market or buyer's market or neutral. It's across the board. It doesn't matter. Insurance is its own beast. And like I've said in the past, when you're buying real estate, if you're not paying cash, you're having the real estate transaction, which is you buying out a seller, and then you having a mortgage or loan transaction, and then you have the loan or the insurance transaction. So essentially, you could have three transactions to bring one together. And sellers need to be mindful that buyers are diligently working through these things as we go along. Buyers, you need to know that you got to work on these things on a daily basis until all the cogs fall into play and things become seamless. So anyway, hope this helps. Obviously, this is just a short list of things that can be negotiated outside of the purchase price. And again, uh, it'll all play in as performance indicators on bringing an offer and making it a contract and having that contract follow through to a sale. So anyway, hope this helps. If you got any questions, comments, concerns, leave them down in the comment box. Call, text, do whatever. Maybe you've had a unique story that you wouldn't mind sharing with everybody else here. I wouldn't mind hearing it too. Like, it's one thing about this business. You get up every day and it's going to be a new day. Something new could present itself. So anyway, thanks for being a subscriber, and catch you on the next video. Talk to you later.